But Marilena, I can't share my screen. Can you hear me?
Yes, yes.
Yeah, but you have disabled me to share my screen. I don't know how you fix that, but I'm not able to share it. There it is. Perfect. Thank you.
So let's see if everybody's already connected.
Yeah, I can't see how many is there.
Okay, let's give another couple of minutes.
Yeah, that's fine. No problem.
I think we have a question.
Yes, let me.
Or someone
see.
raised hand.
The chat. Yes, we have one. Yeah, it's just confirming that the person is there. That's fine.
I think we can start.
Yeah, should we give it a go? That's perfect.
Yes.
Yeah. Today we're going to speak about risk management and how to make that work. This is not going to be a session where I'm going to show a lot of slides, because this is more a talking matter. And I know that a lot of people have different ways to engage in risk management. But what I think is important, that is, when you would like to enter a trade, whatever trade it is, if it's in currency, in equities, whatever, it's important that you always have a set of rules that you feel works for you, and how you can make those as easily accessible as you want them to, and you can have them in your head, you can have them written down, whatever, but it's important that you have a set of rules that you can work with. So let's just go on for. So I have this set of golden rules for trading, and the first one is never open a position without knowing your risk. So, and somehow it makes sense to know what your risk is. If you go into a trade and you don't know what the risk is, then how would you ever be able to handle this? You could easily go into a big profit or big loss, but how do you handle it from there? And it's not that I'm saying that a big profit is a risk, but it actually can be if you don't know how to handle a big profit. And just for this, let me tell you a story from when I was trading. I actually was sitting at the client desk speaking to a client, and he had several trades with good profits in them, and then I asked him, shouldn't you take some profit? No, he said, I won't take profit because then I'm going to pay taxes. And if that's the way you look at it, then it's becoming a big risk. So you have to know what to do. And taxes, yes, it's a bit bored to pay them. At least where I'm from, you have to pay taxes from the profits, but also you can deduct your losses. But it's no good thing to just accumulate a lot of losses just to pay or protect your profits. That's not the way to do it, because then you can be sure in the final end that you will only have losses and no profits. So so it's important never to open a position or enter a trade without knowing what is the risk of these trades. It could be, as I said, going into a loss or going into profit, and when do I want to go out of it? And that's the next one. In the two, define your profit and loss. It's not that I say you have to take your profits. You can move your if you have a stop loss, you can move it, and if you are profitable in when you have moved it, then yeah, you don't have to say now I need it to be let's say 3-1 or 4-1. And when I say that is I want a profit to be at least 3 times bigger than my risk, or 4 times bigger than my risk for a loss. But if you're already profitable, even if you the market moves against you, then it doesn't matter. Then you can just stay patient and have it, and no matter what, you will end out with a profit. I know it's a damn bore to have maybe let's say you have made 10,000 in profits, and you have you move your stop, and if you hit at that, you maybe only make, let's say, 5,000, and it's a terrible bore to have lost 5,000. But still, you have to look at the bright side. You made a profit on this one, and it doesn't make any matter if you have made it 5 or 10, of course. But actually, what's going to happen now is if you have a stop that it would make you profit no matter what, then you can be patient, and maybe it could be now moving towards 15,000, maybe even 20,000, whatever. So that is where the risk is. If you're going to take the profit too early, then you can risk losing money on what you could have earned if you have stayed patient and just kept moving your stop higher and higher and protect you that way. So, but again, it's everybody has a different kind of way to feel about this, and for some it's super painful if they know they had 10,000. Now maybe the stop was hit and they only made 5,000. And they would rather have taken the stop at 10,000, and it doesn't matter if the trade afterwards would have moved to 15 or 20 or whatever. Still, they are happy with the 10,000, and that's fine. But the very big money comes if you have the patience to wait in a trade, and it's profitable, and you can move your stop higher and higher, and in that way protect yourself. So that's important. The next thing here is and this is very important, and more important than maybe just be able to move your stop in a profitable trade. But if it's going against you, and I promise you, you cannot trade without trades going against you, and trading is a risk. There's no doubt about it, and that's the reason why most in trading are going to lose money in the final end, because if they don't limit their losses, they would just add up with a lot of losses, and in the final end they would have lost all their money. So therefore, and in the next slide I would show you what it means when you accumulate losses, and how it's going to work on your trading capital. Finally, I think it's important always to have a rule that says, if I'm willing to risk maybe say $1,000 or $100 in a trade, doesn't matter, I have to believe that this trade can give me at least 2 to 3 times that risk. So if I'm risking $100, I should be able to make at least $200 or $300. You don't have to take your profit at that point, but that should be the minimum you are thinking that this could be. And this is where our technical analysis from the previous seminars comes into play, because when you can see you have a formation that would give you something, and you trade on a break, you can say, okay, I know this is now my risk. Where does this have to go to fulfill the part where I say I'm going to make at least 2 to 3 times, and if that's fulfilled, that's fine. You can enter a trade if everything else you have as the rule for this is fulfilled. Then go in and have the trade. That would be okay, no problem in that. But if it only say my risk is 100 and I can make 100, don't go for it. It's simply not worth it, because you can the risk of losing this is bigger than winning the game here. So that is where risk management is going to help you in the long run, being able to say, this is my risk, but if I'm going to win, then I'm going to win more than I maybe have lost, and that has a great influence in the number of trades that you might be winning over time, and I would show you that later too, but that is very important, because you move your average in your favor if this is fulfilled in the trades. Okay, this might seem a bit weird, but this is if we say you have a capital, and it doesn't matter how much it is, if it's 100, 1,000, a million, it's still the same. And on the left side, you can see if you lose 10% of this, then the capital you have left is 90%. So if you have had 100, you lose $10, then you have $90 back. So simple math, nothing big here. And it just goes down there. It's pretty simple. If you lose 20%, you have 80 back, 30, 70, and all the way down to 90, you have 10% back. And of course, the lower you go, you can go to 100. If you lose 100, no more trading capital back. And then you're out of the game until you have a new set of, or a new load of capital to trade. So therefore, it's important that you don't lose all of your trading capital, because then you are out of the game. And it's also important to say what you're trading, it's money that you are able to lose, or it doesn't matter, it doesn't make it's not what you are living for. And if it is, then you have to be even more clever about your risk management, because then you can risk losing everybody. And we had a pretty good case not long ago where he lost whatever, I think $3 billion or something like that, or even more. So and now out of the game, and a lot of customers is out of the game, and that's not the way to handle risk. So you have to be able to handle it in a more clever way. If we move to the right side of the screen, then you see if you have a capital now, you have lost the 10%, you have a capital to gain back to the 100%. Now you have to earn 11% to do that. And if you move lower, you can see if you have lost 20% of your original and you're now at 80%, to come back, you have to make now 25%. And now look, if you go down to the bottom, if you lost 90% of your capital and you only have 10% back, you have to make 1,000% just to come back to your 100%. So, and that would be, of course, it's possible, and sometimes we see it in the equity markets that something has risen 1,000%, but being able to move into that and with the rest of your capital, really taking a big chance, that would be, it should be impossible to do that with a proper risk management, and therefore it would be almost impossible if you have lost 90% to regain all your capital. So you have to do it, if you're down there, you have to do it in baby step, and you don't want to get down there. You want to be able to stop this way before, and let's say if you maybe lose 70%, I can't say where this should be, but let's say 70% is a golden figure. You have to step back from the market. You have to look what is going wrong. Am I maybe impatient? Am I taking too big a risk? Is my position too big? There can be a lot of things that's going wrong with your trading. I think everybody has been there. So in the beginning, you have to be a bit more careful and manage risk a bit harder, and trying to find out what works for me, what doesn't work for me, and the thing that works, I should be doing those, and the things that doesn't work for me, get them out of their way, and then trade in a different way. So it might be that you maybe having a start capital of, say, 10,000, then it could be a good thing maybe to start with a capital, just cut it into a smaller portions of that, maybe say $1,000, and trade out from that and see what works, what doesn't work. And if you lose the $1,000, okay, you still have 90% of it, and it should be possible to gain 11% over a period of time, but then you have to be careful with the trading capital that you have from the beginning. And what I have seen a lot of time is too big a position, people that maybe have a pretty decent stop, but then when you get close to it, they just move it lower and lower, so they lose more and more, and the market can stay irrational much longer than your capital can. So that is a very big risk to have it, or not to be able to execute on your risk management. If you say, this is my stop, then take that stop and make sure that this is done. And if you hurt by this, then step back from the market, find out what did go wrong here, and then maybe try again. And that's the way to do it. It takes time to learn how to trade. I can say that some people is damn good at doing analysis, and they can come up with good trades every time. But if it comes to trading, when they trade, they do a terrible job. That is two very different things, and it's a very different game to be trading contra or doing the analysis. Analysis doesn't hurt if it goes against you. It's just okay, bad luck this time. But if you trade, then it's money you have on the table, and when they are gone, you have a problem, or might have a problem. Some people even think that it's nice to lose because they have this feeling of something is happening. The adrenaline is working around. If they lose, it's excitement, and that is very dangerous to have this in this type of game, because when you have money on the table, you feel this is excitement, and oh, this is good, and it can be bad if you feel it's as good as lose money as to win money. So that's not the way to go. So risk reward is some of the golden rules, but the risk should always be 1 and the reward 2. So again, if you betting say $100, or you have a risk of $100, you should be able to make at least $200, or even better. If you risk 100, you should be able to make 300, and we can of course go up. It makes no sense if you say I'm willing to risk 100 and I will be willing to win $1 million. Yeah, of course, everybody would be willing to do that, but you have to make some sensible risk reward ratios, and if you win a million, that's just brilliant. Then you can raise your game, but it really doesn't make any sense to just say that I'm going from 1 to 1 million. You have to be patient, and it takes a lot of time to steady over time be able to get more and more trading capital. But that's the way you're going to end up winning in this game by doing so. So this is important. If you turn this around, and as I said, 1 to 1 is no go, 1 to 2 fine, 1 to 3 even better, 1 to 4 that's classic. It would be very nice to do that. So, but 1 to 1 million, not going to work. So risk reward, what do we want? And just to make this simple, I said if you had a capital for 1,000 and you're willing to risk 1%, then you're willing to risk $10, and the reward should be then 2 or 3%, depending on what you are, what kind of trader you are. But if you're a day trader, I would say it should be at least double and ideally triple, so 2 to 3%. So if you're willing to risk 10, then you should be able to make at least $20 or $30 on that trade. And that might sound very low, but it actually isn't. You could easily, if you're trading too big, whatever, if you have a capital of 1,000 or 10,000 or whatever it is, if you're trading too big, you could easily lose that just by a correction going against you or anything like that. So be careful. The market might look more rosy than it is. Even small thing can work against you. So for a day trader, that would be my estimate, that you should go for a risk about 1%. If you're more long term, you have to be able to up your risk game. Otherwise, you will end up losing every trade you are going into. So maybe that's 2%. And medium term here is maybe from everything from a week to maybe a month or something, maybe even 3 months. But then if you're willing to risk 2%, you should be able to make at least 4 or 6%. So $40 to $60 in this case. And for the long term, even more risk is needed to go on, because at some point the market will work against you, and then maybe you have been able to raise your stop, but if you're unlucky to trade inside a correction or a sideways pattern, then even 3% could work against you, and in this case you should be able to make, and that would make up to $30. So you should here be able to make at least $60 or $90. And this is important, because if you do this, then not every trade has to work work for you. You can actually lose money on more trades than you win. But I'm going to show you just this. On the InstaForex, there is a calculator, and you can show whatever you want to do, the currency pair, if you leverage, and leverage is I think one of the most dangerous things that you can have in the forex market. If you have a very large trading capital, then leverage can be super good, and if you have super deep pockets, then that's the way to do it. And but if you have a small capital, then don't go that way, because it can wipe you out just in a second, and you can actually lose even more than you have as a capital. I'm pretty sure that there are some restrictions in the InstaForex. If you have 1,000, then you can lose that as a max, but it's very quick to do that if you start doing leverage. So be careful going that way. And you can see even with a very small size, that would easily go up to a margin of 200 here. So if we are talking as we did before, $10, so you have to go half of this size. So we're now down to 0.008, and then we're down to half of this, and we're down to almost $20, and we have to cut that in half too. So now down at 0.000, no, 2 zeros and then 4. So you can see that you have to go down small, but it's, if you're new, that is a perfect way to try to see how does things work, and doing it that way. If you have already some experience in trading, then go from what you have, but still go back, look at your risk reward, and look at your trade. Do I know what my risk is? Do I know when to exit the trade? At what price should I do it? Actually, it would be a benefit to put in the stop loss already when you enter the trade, and then just say, I can't move it from here. It's stuck until I can move it higher, but never lower. I have seen that a lot. Also from professionals, I've seen them go in and say, we like this trade, blah, blah, blah. And we will put a stop here. And then the next time it gets closer to this stop, and they say, oh yeah, we had this stop, but now we would lower it a bit because we still believe in this trade. You can't do that. You have to, if the market is going to hit that stop, you have to take it and then look for, maybe you have you like this trade and you could enter it again and then find a new stop, but don't move it lower, because then it's just, then you have already given up on your risk management, and then it's a totally new game. You're going into a game of make believe, and you no longer have the same if you have been analyzing whatever, say euro dollar, and that was the reason why you entered this trade on with this risk reward, and now you have moved it, then this is a new trade, and everything is different, and you have to look at it from a new perspective and find out. And then you might say, I still like it, I can see there is a possibility here, if I do this at this price and I have this risk, perfect, then go into it again, but it's a new trade, it's not the old one. And if you move your stop lower and take a higher risk, then you're in a totally different game. You're no longer trading. Then you're in make believe, and or just believing, and that's not good for trading. That's something that is best to do in Sundays at a different place and not in the trading arena. Okay, so. And this is what I said, if you have a proper risk reward, you don't need to be right all the time. You actually only need to be right 40% of the time. So you can actually, just by winning 4 out of 10 trades, you can actually make money. And that is the way the professionals do it. They are able to do this again and again and again and again. And because they know what their limits are, they follow the rules. They know that over time, if they do it this way, they would win this game. And it's a bit the same as if you go into a casino. Not that trading is a casino, but it's a bit the same. They know when they are ahead and they have to stop, or they know have to go back, and yeah, we know that the odds winning in a casino isn't good. They're actually better in the trading environment. But the reason why a lot of people are still losing in the markets are that they don't follow their own risk reward rules, if they have any. That's important too. It's very important to say a lot of people don't have any rules going into the market. So that's even worth, if you don't know what the risk is and the potential reward is. Then you will end up with a lot of small trades where or a lot of trades where you have very small profits, but you will let the losses run, and that's just dangerous. And it will just be a matter of time before you're going to lose everything if you have um, that mindset going into a trade. That wouldn't work. So this is why risk reward is important, and you know when to take the risk. You know when to maybe move your stop loss higher and say, okay, now my risk reward has changed. Now, no matter what is going to happen, I would have a profit on this, and then you don't have to take the reward anymore. That's just what I was saying in the beginning of this seminar. That is the optimal way. And when I'm doing analysis on, or used to do it, now it's not illegal to show or say in those analysis that we would like to take this and this trade, and we would have this stop. It was pretty common for me before the GDPR to say, okay, we remove our stop loss up to here, and now we'll have profit no matter what is going to happen. Then you can remove your reward. Then it doesn't matter anymore, because no matter what happens, you will make money. And if you're in a very strong trend up, then it doesn't matter. Then you can just keep on moving it higher and higher, and you would pretty soon be better than the 1 to 2 or 1 to 3, and maybe even 1 to 4 or 1 to 5. And that's the way you want to do it. And that is the trades that are going to make you the most money, because then you can stay patient, you can stay in them, you can let them work for you. And this is where the big money is going to come. Not that you have to be doing that all the time, but but you have that would give you ease in mind, and you can say, okay, I can be loose about this trade because no matter what's going to happen, I would make money on it. So that is the way to really have a proper risk reward. So yeah, if there is anything, we can come back to this. And I think I've been touching upon this too, but risk in the final end comes down to one thing, and that's you. The way you trade, the way you behave in a trading environment, what you are going to do. So um, going into a trade and not knowing about the trade or not knowing about the risk of this trade, that's the worst. That's no go. You shouldn't ever be doing that. I think right now we are seeing a lot of people being captured in by the cryptos. And cryptocurrencies, that's okay. It's not necessarily a bad thing in any way. I regard it as not being a currency, because even though we call it currencies, but rather as a kind of commodities, because normally when you trade commodities, you trade just one side. I know in this you buy those for dollars or for euros or whatever, but also, that is also something you do with gold and silver, oil, whatever. So you buy them for one currency, and you get something. What is this? And I think somehow this makes sense, but if you don't know what you're doing, and if you don't know what the risks are, if you just move into something and don't have a proper risk management, then you could lose your money just in just seconds, because they have a very big volatility, and you can see if you have followed those, they easily drop 67% in when they have peaks. So that is that could be a very risky trade if you don't know what you are doing. Impatience is a risk in itself. If you can see that you have a formation, this looks good, and then before the formation has been triggered, you say, okay, I believe now this much in it, so I would enter the trade already now, and I would earn a bit more. But the risk is that it's never going to be triggered, and it's just going to turn in the opposite direction. Then where's your stop loss? How could I? How do I handle this? And even if you have the stop loss, you will be mad at yourself because you was impatient. And if that is the matter in trading, then you have to go back and say, okay, this is a problem for me. I have to work on this issue so I don't make the same mistakes over and over again, because impatience is one of the very worst thing we see in trading. People being over optimistic or over pessimistic on something, and it doesn't just happen this way. So you have to, if you took your profit too quickly and now it's much higher, and you say, okay, I'm losing this, so I'm just jumping into this trade again, and then you have the top or the bottom, and it just goes opposite you in the opposite direction, and you're going to lose on that, and maybe even lose more than you gained in the first trade. So and that could be a terrible risk in itself too. So over trading, too big a position, um, happens a lot, and that's because instead of saying, yes, I could make $20, it's much better to say I could make $200, but then the position is now 10 times larger. And then does it make sense in what you're your trading account is. Maybe you're suddenly betting on 10% and not 1% as you did before, and everything changes in that second you're doing that. And I have seen it over and over again, and over trading is one of the biggest risk one can make. And over trading also comes to using leverage. That's just increasing the risk many times. It's common to use leverage in the currency market, 10%, 50, 100, 200. I've seen it, and I can't imagine having a trade where I have a leverage on with 200. If anybody can do it, that's fine, but I couldn't imagine it, and the risk you are getting from having a leverage in that, I can't imagine that, and I'm pretty sure that that's why someone is suddenly going from being this is a great trade to just everything's wiped out in a second. So, and I remember back in the days when interest was a thing, and you had um, uh, when you could trade, say, Turkish lira against the euro or the yen, and you could gain maybe 20% in interest, and it was you would say at that point it was being super nice if you could just have a leverage of 10, because at that point you would go from 18 to 180%. But it's the same on the opposite side. The risk is now 10 times bigger, and if you have $100 in your trading account and it goes against you just with 10%, you're off. There is no more left. So it all comes down to this. Or not only this, but that is one of the big issues when you're trading. Don't ever overtrade. That's just a killer, and it can be very quick. You might not even think that it's a big issue, and then the very next day it's a big issue. And again, the next one is a bit of the same. Don't having a trade plan is a risk. Not knowing, and everything comes back to those issues. If you have a trade plan, then you know what to do, when to do it, and you have in your head seen what the trade can do to the upside, to the downside, where you have your risk and where you have your reward. So that is why you need a trade plan in your head at least. You may not have to write it down. It's fine to do it, because then you can always go back and say, okay, I had this and this, maybe even a chart where you can show it for yourself, at least at the beginning, until you know, this is the way I behave, and when I see this, then this is good, this is not good for me, and that could be a good way to learn it, especially in the beginning of your trading, where one will make mistakes because you don't know how you react to trading, the trading environment, and what's going to affect you and what's not going to affect you. So that's important. And the next one, not knowing how to react to losses or rewards is a risk. Spoke about that earlier. You can have the feeling that a loss is almost as exciting as having a reward. So that can be a danger too. Not knowing when to enter or exit a risk, that is a bit as being impatient. But also, if you come into a trade, you have done all your homework and everything is fine, the trade is going with you, you have entered it perfectly, but where do you exit? So that could be an issue. Or the next one could be even worse if you just enter into a trade because you think this is good, maybe even because you've just heard it from another person or read it somewhere and just, oh, that sounds perfect, I want to do that, and then just enters into that trade. You have no idea where you did it. Maybe it was a good place or it was a bad place. You don't know what the risk is. You don't know where to take your profit. You don't know where to take your losses. Everything is just up in the air. And then when you have done the trade, you have to sit down and find out, where do I do it? Where do I take my stop? Where do I take my profit? What was this a good place? So just believing what others says is a great risk, and you will find out that some advisors trying to sell your stuff would use, and this is especially in the equity markets, they would use a perfectly good story and a chart to say, this is a fantastic opportunity, this can go wrong, and what they are doing is they want newcomers to believe what they're saying, and they can unload what they are having at the right price where they can. So they gain momentum in something where there shouldn't be any momentum at that point. So they are gaining uh, volume in the trade, so they can unload what they have been buying maybe earlier, and that is a very common thing in the equity markets, and the big players are doing this, and big players can be companies that are selling you advice. So be careful about that. You have to be, if somebody says this is a good trade, sit down, analyze it, find out if it's correctly. Always be skeptical when somebody says this is a perfect trade. It might be, it can be a fantastic trade. So that's fine. But then you have done your own homework, not just believing what anybody else says. So, um, and I think that everybody should do their own homework. It's fair to get an idea from another one saying, oh, this looks good, but sit down, find out what's the risk, where do I do what, where do I take my profit, where do I take my loss, where do I enter this trade. It's important to do that, otherwise the risk is going almost exponential. It's a lot easier and a lot quicker to lose than to gain. Um, I can promise you that. I've been here a long time and I've seen it many times. Um, Gaining money is a long process. It's hard. It's going slow, and then sometimes, yeah, suddenly it's like, yes, everything is just coming your way, but losing, that's just like that, and it's quick, and it hurts big time if you're going to do it this way. The last one is actually wrong. I would no, yeah, sorry. Believing that everybody has an equal opportunity is a risk, because not everybody has it. Somebody has much deeper pockets than you have. They can stay in a trade a lot longer time than you can, and then and just that is a risk. And if they are good traders, big traders, they can do things in the market that you have no opportunity or any move, not opportunity, but no possibility to do. They have maybe even better advice. They maybe have a lot of people doing analysis for them in the background, and they know a lot more than the normal guy do. And so believing that everybody is equal in this game, not real. So that is a big risk. I I think I hear it a lot of times that we have the equal opportunities in this market, but we don't. There's a big difference. There's big difference out there, and some has way better opportunities than you have. Also because they are so big that they can even manipulate the market and have it work their way. So So that's important to have that in mind too, if you're going into a trade. So as I just said, somebody is bigger than you, and they're the ones that is too big to fail. And the problem is when they are looking like they're going to fail, then their losses is just going to, from government, just say out to everybody, okay, you have now to somehow pay with this. That's the little guy here. I think you're playing with my money, but the Wall Street guy is having the fun, and it doesn't have to be the Wall Street guy. It can be everything else. It doesn't have to be a big bank. It can be some of the big players. They have opportunities that we don't have, and it's a risk to believe that they have this, or you have the same opportunity as they have. That's not correctly. So I can see that there are some questions. So let's take them from the beginning. Let's see. Let's mind everyone that you can. Yes. Yes, I'm pretty sure that this would be. I know that you can find this on YouTube afterwards, but if you leave a message for Marilena, then you can have a copy from it. I'm pretty sure. Yeah, she has also said that, so just go by that. I have a question, and it is that 1 to 2 means a ratio of 1 to 200 or what? No, it doesn't mean that. If you have, say, a risk of, let's just say $100 US, that's the risk you're going to take in a trade, then the reward should be $200 and not 200 times 200, because that would be $4,000. So the risk is 100, the reward is 200. Even better, 300, and even better yet, 400. But thinking that you can risk one and go to 4,000, that would be an error, and that would be a risk in this one. So risk is 1 to 2. Yes, perfect. Got it. Yeah. Any other? Yeah. What happened to the LIBOR? And can it happen again? Yes, of course it can. I think just look right now at what we have at Evergrande. Everybody right now is talking that this is maybe a Lehman moment again. I'm not sure I would call it a Lehman moment, but what happened up to Lehman, because you had the Bear Stearns that actually went bankrupt before Lehman, and they were taken over by one of the big banks for almost nothing. Right now I can't come. You'll come back to me. But it was that event that started the whole thing back in 2007, and just as small dominoes tip the next one. And in the beginning it's slow. You have a slow movement. It's just one take number two, and it's slow, but then it accelerates and it goes faster and faster. And at some point, the most likely thing that is going to happen is that government, whatever, think that something isn't dangerous, and it is to the market. So that was when they said to Lehman Brothers, "We won't save you. You have been a bore, so you take your losses and you go down." And at that point, if the next one tripped pretty quickly, then it was AIG, and then it was the next one. And if government has just let everything go at that point, the financial market would have frozen up totally. There pretty close to do that. There were major problems in banks moving money around as you're supposed to, even though you have the SWIFT system, and suddenly they said, we want to have your part before we are going to give you your part. That's not the way stuff works. You have to believe that we can share equally. So and it was pretty close to just freezing the total market. And if that happened, then I really can't see what was going to follow, because bank would have been forced to close. You would not be able to withdraw any money, and if you would have, as you saw it in Cyprus, you could maybe have 100 euros a day, and that was the maximum for everybody. You might have 10 millions in your account, but you could still only have 10 or maybe 10 euros or 100 euros every day, and the people that had the most in their account was suddenly they took money out of those accounts, so they was part of bringing down the losses, and that is actually the picture you're seeing here with I'm too big to fail, I'm filling it again, and that was actually what you saw in Cyprus in live, and then we have seen it before other places. It has happened in the US, and everything like we have seen before can happen again. It might not be exactly the same, but you have probably heard it. It rhymes. What you have seen before can happen again in slight different, but still it's pretty much the same. And what we are seeing right now in China can be, I'm not sure it's going to be, but it can be a problem in the next 3-6 months. And Evergrande is just the first problem, and then it moves down the line to the next ones, and it's all depending on, is the trust there, or is the trust maybe suddenly not there in the market, and if trust is gone, then everything is a problem. This market is built on trust, so you have to trust whatever is going on. If trust is away, then major problem in the market. So yes, things like that can happen again, and this LIBOR thing, yeah, absolutely. Any other questions? Perfect. Then let's wrap it up, and thank you for this time. There will be a class again in October and November. Marilena would send out what they're going about, but I know one it would be for the Elliott wave. Yeah, and I think we will have one that is where we are live, where we will show trades directly, or not trades, but how we would enter a trade, how we do all this stuff live. So interesting. See how that works. We have to go down to the shorter time frame to show it perfectly, but we can take some examples from the larger time frames too, so you have an idea what I'm looking for. But at that day we'll start there, but that will be more about it later. But I think that will be in end of October, and then end of November there will be a seminar on the Elliott wave. I think it's that way around. So I hope I see that you're there again. That would be a very interesting one. Perfect. Thank you for this time, and have a nice evening, and hope to see you again in October and November. Bye, everybody.